Hello, credit union executives. Welcome to See You on the Show, where we give you up-to-date information on how you can reduce risk, keep key talent, and take a strategic approach to your personal financial wellness. Hosted by me, Doug English, a certified financial planner and former credit union insider with ACT Advisors. Here with me today is the retired president of the South Carolina Credit Union League, Steve Fowler. Welcome, Steve.
Hello, Doug. How are things going?
Oh, things are wonderful. How are things for you?
Things couldn't be better. I thought before I talked to you about my career in credit unions and how I got started. I had just graduated from the University of South Carolina back in 1970. Ooh. I had met the love of my life. We've been married over 50 years now. And I was looking for employment. And my neighbor up the street stopped by one day and said, "Have you found a job yet?" And I said, "No." He said, "I'd like to interview you." And he ran the audit division for credit unions of the South Carolina Credit Union League. And we went over, interviewed, and to make a long story short, I was hired. I served in just about every capacity in the league that was available in the service corp and the corporate. The Peter principal finally took over when I became president and CEO. And after 5 years, they realized that 43 years was time to say goodbye. Now, actually, Doug, when I took over as the president and CEO, our management team had been looking at our market. In other words, the number of credit.
Hang on, Steve. I want to stop you. I want to back up a little bit because you just said a whole lot right there.
All right.
Did you get done with college and go straight to the credit union league? And so that was the only place for your whole professional career?
That's the only full-time job I ever had.
Wow. That's extremely unusual, right? I mean, not
really. When you worked for the South Carolina League, once that got on your resume, you could not get gainful employment anywhere else. That was explained to me by Tommy Dell, another former president of the league.
Well, tell me about the structure of the league. Like I know from knowing you that there was a service corps and there's a league. Talk about that structure, please.
All right. When I came to work with the league back in 70, the league consisted of the league, i.e. Trade Association for Credit Unions, nonprofit. We had a service corp, which was a for-profit. We did statement mailing. We had a print shop for newsletters and whatnot. We had an insurance services division for credit unions, and we had a marketing division for credit unions. We also had the corporate credit union. And back then, it was called the League, South Carolina League Credit Union. It not only served credit unions, but it served groups too small to have their own credit union. This was before credit unions were allowed to take in different groups. At that point, we became a true corporate because we were competing for those groups with our existing credit unions. So we spun those groups off to individual credit unions, and we became a true corporate. But back in 70, we also had a data processing company called QAC, Credit Union Accounting Center. And we managed that. The credit unions actually owned it. Each credit union purchased a share of stock, $1.50 for every member account that they had. Every member, not account. Members had different accounts. So there were four different entities when I came to work. By the time that I left, the service corporation had blossomed. We were doing check clearing for credit unions, not just in South Carolina, but in probably 32 states. We were doing statement mailing. We mail statements for our credit unions. And when I say mail, we delivered electronically and whatnot for credit unions across the nation. We actually did item clearing, share draft clearing for credit unions in Hawaii. I always wanted to call on those credit unions. They would not let me. But the league itself had a league president. Yes, sir.
So, Steve, tell me about how you had a lot of different entities at the South Carolina Credit Union League. What caused those to come into existence? Was it driven by the need to diversify revenues for the league, or was it driven by the member credit union needs? And then when you have had that all built out, what was the way the revenue flowed in? Like how much came from the member services versus the service corp?
When we offered any service to a credit union, whether it be through us coming online and offering that service ourselves, or whether we endorsed someone who offered a service. And for us to endorse someone was quite an involved process. We didn't endorse just willy-nilly. We didn't endorse just for the revenue stream. We explained to whoever, after we did investigations to make sure they were compatible, that if they had a problem with one credit union, they had a problem with 200 credit unions. Ooh. And that kind of kept all of us on the same page. The way we were structured, the League Credit Union, of course, was a credit union, supported itself. The accounting center, the computer processing, was a separate entity. It received its revenue in fees for processing. I think in the beginning it was 15 cents an account a month, and that included statement mailing and all that kind of stuff. The service corporation was only chartered in order the internal revenue, let me back up a second, the internal revenue would not to make a profit from outside services and maintain its tax exempt status. So rather than try to have our accounting department note this was for profit, or these are league dues and are sheltered, we said no, we'll form a profit-making entity, which was our service corporation. Their funding came from our revenue stream from our insurance services division. Now, the Kenna Mutual income went to the league because that was credit union related. We offered insurance on automobiles, mobile homes, and stuff like that before Kenna Mutual got into that area through our insurance services division. We did the statement mailing. That was a revenue product that generated income locally. Our print shop was the same way. The league was funded primarily by dues from credit unions and also income stream from Kenna Mutual. And the whole operation, you had at the top of the pyramid, I guess you would say, sort of your league president. But just under that were three vice presidents, your corporate, your service corporation, and the accounting center. So that was your management team, your senior management team.
Was this a pretty normal structure of a league from what you saw across the country?
From what I saw in the beginning, I didn't do a whole lot of travel early on. An auditor, I lasted almost 14 months as an auditor before they called me in and said that I was not cut out to be an auditor, that I didn't understand that auditors came in after the battle and shot the wounded. I wanted to nurse them back to health. And they moved me over to member services rep. And then I started to travel a little bit. I got to go to Mecca. I went to Madison and got off an airplane in 4 feet of snow and knew then that the Southern boy wanted to go back home. But what I saw in other leagues was we were a little different. Bill Brocksterman is the guy who really set everything up in South Carolina as far as the way the league was structured. Other credit unions are morphed into doing similar things.
So tell me about the trends that drove the league to kind of reconsider its existence and the way things were operated. Like what trends did you start to see, and how did those trends change over the years?
As credit unions were able to take in groups to offer checking accounts, to diversify their services, i.e. mortgage departments, CDs, that kind of thing, we saw a big boost in your larger credit unions. Those that had the resources jumped in full bore and began to really grow. Your smaller credit unions were really, really worried. They could not afford ATMs. They could not afford checking accounts. They couldn't afford debit and credit cards. And they were like, we're doomed. We're just going to be a small savings and loan club, and that's it. Mm-hmm. And so some of them began to look around and to try to find a compatible philosophy with a credit union, and they would merge. We had noticed over the years the shrinking number of credit unions. And when I became CEO, the very first month, we took the senior management group out on a weekend retreat, and we sat down and we looked at every credit union individually. And we said, since the credit unions are our market, let's look at their markets. Let's see what they need from us. And we kind of were brutally honest in our assumption, and we saw a continued decline in credit unions. We also saw a market from our end that was rapidly changing. Our larger credit unions were outgrowing some levels of expertise that we would need as an organization, as their trade organization. Our strongest need for them was in the governmental affairs area to protect in regulation and legislation and that type of thing. Our smaller credit unions really relied heavily on us for audit. We had a bookkeeping service or an accounting center for smaller credit unions. And I shouldn't say just for smaller credit unions, because some of our larger credit unions used it for bank recs and that kind of thing, which their auditors loved, NCUA loved. But as we looked at the credit unions markets and our market and how we could best serve, it didn't take a rocket scientist to realize something needed to happen. So we added strategic discussion, was what we called it, to every board agenda. And we would sit down and we may spend 30 minutes, we may spend half a day talking. And during that first weekend retreat, we developed 4 different strategies or outcomes for the board, i.e. status quo, we'll just hang on as long as we can, and let nature take its course. We could try to combine services with another league, just sort of let them be the expert in this area. We would develop expertise in this area. We looked at merger. And then we also decided, is there a fourth option out there? And we looked with Texas at the regional concept at that time. Bear in mind, this was probably around 2008 or 9, forgive me. In retirement, brain cells die more rapidly than when you're active. As we began to move forward looking at these various options, we would discuss them with the board. What we finally came to was the idea that we would invite leagues philosophically aligned, geographically close, to come in and talk to us about what they had. At this time, Florida and Alabama had already combined into one league. And we invited them to come in, League of Southeastern Credit Unions. We had Georgia come in. We had North Carolina come in. We had Virginia come in, and we had Tennessee come in. We were doing businesses in all of those states through our service corp. With North Carolina, we had done a great deal. Our corporate was together at that point. We did joint staff meetings, joint training. Philosophically, we were aligned, but we met with each of the leagues. And how we did that was we invited the league president and any of their staff they wanted to bring at that time, and their board chair to come over. And we would go off campus and we would spend a complete day meeting and talking. And we'd bring them in the night before, take them to dinner, and then spend the whole next day going through options and whatnot.
So, Steve, you started interviewing leagues throughout the Southeast. And was that because you had decided on a particular outcome for the South Carolina League, or through these interviews, you were going to figure out the outcome for the league?
Doug, it was a combination of the two. We were talking with the leagues to see if there would be the possibility we may partner with another league on various services. We were also considering if we were to merge our league or combine, were we philosophically the same? What type of services would our credit unions gain that we didn't? Would they lose any of those services? What's your due structure like? All of that type of thing. What we were trying to do when we began that process, as I said, we had seen the trend and it was not good. We wanted to be proactive. We wanted to, I guess, in effect, kind of come to this problem where we were dealing with a position of strength and not weakness. We didn't want to wait till the well was almost dry and kind of have to come with our hat in our hand and be forced to make a decision. And so that's how we came about this method of sitting down with the credit unions, leads, and talking.
And has this trend, obviously the point we're going to get to is what the decision you finally made, but have you seen this trend continue for other leagues throughout the country? Obviously, we've seen it very much for credit unions. I assume the trend is also there in leagues?
Yes, it is. Yes, it is. I have not remained real active on the out-of-state scene. I still work with some credit unions in training and planning sessions and whatnot in the state. But I do sort of keep up with where things are going. I think that, as you just mentioned, credit unions are combining to be able to reach economies of scale, to offer their members what they need. You're seeing the same with leagues. Leagues are really different creatures. The only thing you have in a league that you can say you offer is service. And your people, the experts, are the ones that bring that to the table. So you're top heavy in a league as far as the cost to deliver that expertise. However, credit unions with limited resources, especially in low interest times, want their dues to be as low as possible. They want to be what Tommy Dell used to say, the highest paying dividend or interest rates and the lowest price loans. And that would be absolutely wonderful. I would love to have a wife that loved to cook and didn't spend money. I don't have either. But as we were looking and finally settled on the fact that North Carolina, it was pretty much identical to South Carolina. They faced the exact same problems we did. We met with their board. We had joint board meetings and staff meetings together to discuss this. And what we ultimately decided to do was, if the credit unions approved it, we would liquidate the two leagues on the drop dead date and form a brand new league called the Carolinas Credit Union League. Governance was to be split fairly equally between the two states in the beginning, and then the members would elect board members the way that we came up with in the bylaws, which again required representation at a certain level from both. We flip-flopped the annual meetings, 1 year in Myrtle Beach in South Carolina, 1 year at Pinehurst in North Carolina. We, on the quote-unquote drop-dead date, I had already announced my retirement for that date. And John Radebaugh, who was president and CEO at that time in North Carolina, became the new CEO of the new league, Carolinas Credit Union League. And what really drove us in doing what we did was not just to ensure that the entities succeeded and continued, but it was in what services credit unions needed. In both states, the final vote in South Carolina, we had 52 credit unions that actually voted in favor of the merger and 2 that voted no. And in North Carolina, they had, I think, either 1 or 2 no votes and a yes vote. So we spent over a year going around to credit unions and meeting with them, regional meetings, chapter meetings, educational sessions at every gathering that the leagues hosted. I would bring John into South Carolina. I would go to North Carolina. We made our staffs interchangeable. We were already using a legal or compliance service that North Carolina had. We were doing printing and check processing with them. Our audit services were interchangeable, and things went really, really well. When I retired, I will tell you that I at times used to worry about the future of the movement because I would see these trends going the wrong way. But when I retired, I had a really good feeling, and I can tell you that I've stayed in touch with staff from both leagues, and I really still have that good feeling today.
Wonderful. Looking back, Steve, then on the process, interviews on the things that you didn't ask, or the things that you didn't think of? Is there anything that kind of stands out? And I know you said you could take up hours with all the mistakes you made, so we won't cover all of them. But just in regards to the process of deciding to merge the league, of figuring that out, is there anything you kind of go back and say, oh, I wish I'd done a little bit more of that? That was a real detail that was important. And again, of course, we're talking to other league leaders that might be in the situation.
Sure. I think when I look back on it, there are a couple of things that kind of stand out to me. I really, really wish that we had come to a decision a little sooner and spent more time meeting individually with credit unions. I tried to meet with as many of my CEOs and their board as we could to answer questions, to make the presentation, to let them know why we were doing what we were doing, what the effect would be. And I think John did the same in North Carolina. I think it's kind of tough when you're trying to get around and see 89 or so different credit union CEOs. It was interesting in that the 2 no votes in South Carolina are one of the credit unions that voted no just had told me early on when I met with them, they understood the need for it, but they just weren't ready to let go. The other credit union CEO met with me, would not let me meet with his board, and I could kind of tell where he was coming from. And he didn't want to see it. But I think like I said, the other item, and it kind of goes hand in hand with what I'm talking about meeting with credit unions, our smaller credit unions were very concerned that they would be left out. We had a division in the league that we called our emerging credit union service, and that was to concentrate on those credit unions. And we kind of drilled into their heads that the emerging credit unions weren't all small credit unions. We had a very small hospital credit union that decided if we're going to exist, we got to have checking accounts. Well, every model we ran showed they weren't going to make it doing checking accounts. Didn't matter. They did checking accounts. They got into ATMs. That credit union today is a flourishing, about a $300-400 million asset credit union. I guess healthcare is where you want to be.
So kind of it sounds like when you look back on that decision, it looks like the right decision. And obviously credit unions are flourishing throughout the country. Your feedback to try to spend more time meeting with the leaders of credit unions from a state as small as South Carolina seems fairly much more achievable than the size of a lot of the states. Maybe they don't have as much density in credit unions. I guess that would depend. But thank you, Steve Fowler. We appreciate you greatly. Thank you, our listeners, and we'll look forward to talking to you next time on See You on the Show.
Thank you, Doug. Appreciate you having me.
That's all the insider credit union knowledge we have for this episode. Can't wait for the next episode? We're always available through our website at act-advisors.com. That's ACT-advisors.com. See you next time on See You on the Show.
The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual security. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Economic forecasts set forth may not develop as predicted. All performance referenced is historical and is no guarantee of future results. Indexes are unmanaged and cannot be invested into directly.